All right, let's start. Thank you guys very much for joining us. As we always say these days, I really hope that you're staying safe in the middle of these uncertain times, and that it's great that you still find time to participate in another Into the Block webinar series where we try to discuss some of the new and hot and interesting trends in the world of crypto assets from an analytical perspective. Today, we're going to talk about a very controversial subject of exchange fake volumes and liquidity. So this is an area that we have some new ideas, and we're doing some work with some of our customers on it, but it's an area that has sparked a ton of controversies and a lot of good and bad ideas within the crypto community. If you haven't been to another one of our webinars, my name is Jesus Rodriguez. I'm a co-founder and CEO and current CTO as well of IntoTheBlock. A computer scientist by trade with a long career in artificial intelligence and machine learning, and now we get to mix those worlds with crypto assets and try to drive new insights and interesting perspective about the behavior of this new asset class. So for today, in 30 minutes, we're gonna try to provide some new ideas about the topic of exchange liquidity. So we're gonna look at the liquidities and bad behaviors in crypto exchanges. Uh, provide some perspective about the traditional methods, what work, and what areas we think are a little bit lacking. Um, Look at what blockchain data sets bring to the table when it comes to analyze exchange liquidity. And I would like to present a few ideas for you guys to consider in this new area. Again, this is not even part of the Into the Block Pro. These are some new things that we have been exploring. And so this session is more about giving you guys some ammunition to think about. That's something really related to the Into the Block platform. So why is crypto exchange liquidity matters and is so important? So in the crypto market, we're constantly hearing news of crypto exchanges regularly manipulating volumes and other aspects in order to gain relevance and the attention of investors, particularly in unregulated exchanges. Liquidity is one of those metrics that is a great indicator to judge the long-term viability of an exchange, but it's also a key indicator to detect bad behavior. And if you're a trader or in the space, either a discretionary or quant, liquidity is one of those aspects that you typically looked at in order to operate a specific strategy. So in the crypto space, liquidity is without a doubt one of the biggest challenges of today's market. In the current composition of the crypto space, we're seeing all sorts of bad behaviors. I mean, this is not new. It certainly has gained more relevance in the last few years, but we're seeing in crypto exchanges all sorts of behaviors with wash trading, spoofing, front running, tape painting, and all sorts of different mechanics, right, to fake volume and trades and things like that. So I would like to take 5 minutes to explore some of the most common bad behaviors. I mean, we hear this terminology all the time, but sometimes we don't really know what it means. So let's take 5 minutes to walk through some of the most common patterns of bad behavior in centralized crypto exchanges, which you also find in capital markets, except that in traditional capital markets, all of this is because they're regulated entities, all this is punishable by law. And there are other incentives that keep those exchanges very, very efficient. So wash trading is probably the most common bad behavior that we see in crypto markets, and this is a pattern in which investors and individual investors trade with himself, right, to simulate, or it could be the exchange itself, or it could be an entity that simulates trades with himself to sort of inflate the volume, or in some cases is to trigger commission-free fees that go to a broker that they partner with, and things like that. So this is by far the most common bad pattern that you find in crypto exchanges. Spoofing is another one. In which I mean, you can think about like a wash trade, but in this case are trades with very large volumes. So very large buy or sales orders that are intended to sort of simulate a market sentiment. So if you see a very large purchase, you can interpret that as a bullish sign in the market, or a very large sales order as a bearish sign on the market, and it's completely fictitious. Front running is an area that became very prominent in capital markets with the emergence of high frequency trading in the 2008-2009 time frame, but in the crypto space also exists, not so much in the high frequency connotation, but literally exchanges looking at an entire order book and parking their orders before yours, right? So if you have visibility in the entire order book, you can really decide which orders should take priority over which other ones, and make difference on the fees. This is very, just to clarify, this is very different from the traditional front running in high frequency trading, which is mostly based on trades that execute in dark pools. So the way high frequency traders operate, the dark pools are these areas where shares change hands in traditional exchanges infrastructures. And the high frequency trading systems have access to the dark pool. So when they see a large order, let's say that I'm buying, I don't know, 100 shares, 1,000 shares of Microsoft, they could see that order and park themselves before my order, buy 1,000 shares of Microsoft and sell it to me on the way back and make the difference on the spread. And that's a traditional front running. In this case, we're talking in a more simplistic way, in which an exchange that has the entire order book can front run orders in order to make the difference. And then another one, another pattern that is maybe not so well known is this one called painting the tape, in which it's a variation of of wash trading, but in which instead of a single actor, you have multiple actors. So you have multiple players, multiple companies that decide to trade with themselves and fake volume that way and attract other investors to the exchange. And this happens all the time. So exchange liquidity and fake volumes, I like to refer to as the white whales of crypto markets, right? It's one of those problems that we keep going at it and trying to come up with good ideas and solutions, but it's far from trivial. So we certainly applaud any solutions that have come out and methodologies that have come up in the space. We obviously have our opinions about it. We think some of them are very limited and some of them are more meritorious in terms of the robustness of the methodology. But in general, this is the important thing to understand. This is that this is an area that is very, very hard to solve. If you remember, if a couple of years back, the whole thing about fake volumes took prominence based on an important report that Bitwise published with the SEC, in which they make some bold claims that 95% of the volume in crypto was fake, and things like that. The report certainly brought the issues of the crypto market to mainstream. I mean, it was people that were not thinking about this at all. Now they were very aware that this problem exists. And in that case, the report had a lot of merit, right? What is certainly by far the most important research report ever published in terms of fake volume and liquidity in the crypto space. What we did find though is that the core focus of the Bitwise report was to highlight some patterns and of crypto exchanges that could be interpreted as bad behaviors, and try to discriminate the good exchanges from the not so good ones. However, I'll say a few months after that report came out, all those techniques were completely obsolete, because the analysis that was used in that report was very easy to manipulate. It was based on order books and trying to spike anomalies using trend analysis. And if you're someone who is trying to gain this out, those things are very easy to manipulate. So from that perspective, we believe that the Bitwise report made a tremendous contribution to the crypto space in terms of highlighting this issue. I personally do not think that it offers any long-term solutions, right? I think that a lot of the statistical analysis that was used there is incredibly easy to manipulate, and that was exactly what has happened a few months after. I mean, I have the head of research of one of the prominent crypto data providers out there use this phrase that makes me laugh a lot, that said that a few hours after the Bitwise report came out, all those techniques were irrelevant, right? The bad actors already adapted to how to game the system. So since then, the market, we have seen an obsession about trying to solve this problem, right? So we have seen all sorts of people, entities coming up with liquidity metrics and exchange rankings and all sorts of things. Fundamentally, I mean, with some exceptions, but if you go look at the market today, there are two core data sets are being used to analyze this. One is order books, and another one is web activity like traffic and metrics like that. These metrics are certainly relevant. These data sets are certainly relevant, but they're extremely trivial to manipulate. I mean, manipulating an order book, if you're an exchange, or you're a bad actor with a series of bots and things like that, it doesn't take any scientific rigor to do that. And from another perspective, order books we feel are great at detecting. Analyzing order books are great for detecting things like anomalies, right? Like you see trades that deviate from the norm. They're too large, they're too small, the sequence doesn't match traditional patterns and things like that. But how do you really infer liquidity from an order book? I mean, that's really not possible, or if nothing else, it's a very, very inefficient way to do it. So if you're trying to understand the liquidity reserve of an exchange or trying to get measures about liquidity, order books is probably not the right place to look to try to solve this problem. But most importantly, this if you're using this data set that are that anybody can manipulate, is a race, right? In which a vendor comes up with a somewhat robust methodology, and then the bad actors adapt to it, and it becomes this one step at a time thing in which you never know if the data that you're receiving, the metrics, are really robust. And that's what we're seeing with a lot of those rankings. That I mean, there's some again, as meritorious as they are, because this is a really hard problem, there are some very important flaws that need to be addressed. So our perspective on this, and we have been advising some of the companies working in this problem, our perspective of this is that there is not a single solution to this problem. Quite the opposite, right? So we think that tackling, in a market in which you don't really have total visibility into what's happening, tackling things like fake volume is tackling one problem at a time. You need mechanisms for detecting fake volume, and or for wash trading, and or for spoofing, and another for simulated web traffic and things like that, and try to combine all those into some sort of data set that give you an indication of discriminate good exchanges versus bad ones. The idea of coming up with a single score for this, I find it questionable. Is summarizing this problem to a single number is too difficult to do. It's probably not going to be reflective of the complexity of the problem. And what's going to happen is you're going to have all the bad actors just gaming the system to try to increase that number, that score, because they have an accurate measure, quantifiable measure of what the problem is. So I don't. Maybe it will work. I have serious doubts that you can really summarize this whole thing to a single problem. So let's look at a different dimension. So far we have been talking about the problem. Let's talk about some ideas of what could be what could be a path to a solution. So centralized exchanges, when you think about good versus versus bad. Centralized exchanges, they need to interact with blockchains today, right? To move money in and out of the exchange, you need to interact with wallets in the exchange. This is something that you cannot avoid for the most part. You can certainly do a lot of trades and move money inside the exchange infrastructure without reporting it on chain, but getting in and out typically it requires blockchain infrastructure. So why don't we look there to begin with, because that activity in blockchain is expensive and hard to manipulate. You can do it, but it costs money and it's very difficult to do because you know how these decentralized ledgers produce blocks and things like that is not something that any party can control. So the obvious thing is, well, can we really look inside the blockchain and try to analyze the data for a particular exchange? That seems conceptually trivial, except that the data at a blockchain level is anonymous. So how do you know that a specific addresses or transactions belong to a specific exchange? So this is a problem that we did tackle for other issues. And what we found out is that using machine learning techniques, you can really understand, classify exchanges at the blockchain level. So understand if an exchange, particular address or transaction belongs to Binance or Coinbase or Kraken or other exchanges. So at a high level, when you look at the architecture of any centralized exchange, there are 4 building blocks that you should think about. So the main interaction point between the outside world and an exchange is what is called hot wallets, right? It's where you deposit the funds. Funds that are in custody or that they're not actively being used, the reserve of the exchange, those addresses is what is called cold wallets. The addresses that deposit into the hot wallet is what is known as deposit addresses, and the addresses that receive the funds out of the hot wallet as withdrawal is what is called withdrawal addresses. And with some liberties here, the architecture of any centralized exchange is a permutation of these four components. So using machine learning classification methods, you can actually look inside blockchain data and start classifying whether an address is a hot wallet, a cold wallet, the withdrawal address, a deposit address. We have done already webinars about this, published articles and things like that. So we have published a lot of content relevant to this topic. But this image here is, if you want to use the analogy, it's like looking inside the brain of a machine learning classifier, in which it's identifying anything that is a green dot is a hot wallet. The withdrawal addresses are the orange dots, transactions going into the exchange are the blue dots, and things like that. So you can map out the taxonomy, the architecture of an entire exchange. As a matter of fact, these classifiers have gotten so good that we can identify individual exchanges. So this is the architecture of Binance, in which there is a single hot wallet, multiple cold wallets. Look at the black dots, deposits groups in large numbers, like hundreds in a single transaction going into the hot wallet, and withdrawals from a single transaction going to a large number of addresses. This is the architecture of Poloniex, in which it uses 2 hot wallets. It uses 1 hot wallet to receive all the funds and 1 hot wallet to distribute withdrawals. And like that, we have analyzed dozens and dozens of different exchanges, right? And we can go on and on about this topic, but how is this really relevant to exchange liquidity? So what I want to do in the last 10 minutes of this webinar is to present 5 ideas that I think could be a complement to the existing methodologies of analyzing fake volumes and liquidity, and that remain largely unexplored. Largely unexplored because this is brutally hard to do, not because anybody's being lazy, it's because just classifying all this data with high degrees of accuracy and monitoring it over time is very, very difficult to do. So let me show you a few things that probably explore 5 key ideas that probably are going to add a different dimension of how you think about exchange liquidity. So a classic one, if I already know the addresses that belong to an exchange, measure the money that comes in and the money that goes out is a clear metric of regular liquidity, daily, weekly, every few hours. So this is an example of the crash of March 11, looking at the Binance hot wallet. So the green lines and the green bars represent funds coming in to the Binance hot wallets. The pink lines and bars represent funds going out of the hot wallets, and you can see that, for instance, when prior to the big drop of March 11, there were a lot of funds transferred into the Binance hot wallet to be liquidated. So if you want to get a measure of how much liquidity is coming in and out, is available in Binance on regular basis, you look at these metrics, right? The difference between inflows and outflows will give you, for any given period of time, will give you a relevant measure of liquidity. If you look at a fake exchange, at a non-legit exchange, and you look at their blockchain activity, what you're going to find is that these things are all over the place, right? So you're seeing money, huge spikes of money going out that doesn't correspond to money coming in and things like that. And you can use that analysis to spot bad actors and patterns of market manipulation. Now, this is just looking at the blockchain data, nothing else. But here's the interesting thing. So you use the same pattern of looking at net flows and look at the order book spreads at the same time. And those two, if you look at the order book spreads and the exchange net inflows and outflows, they should maintain a regular correlation, a uniform distribution over time. I'm not saying about a specific number, but they should behave regularly over time. And I think the guys from Chainalysis actually did some analysis on this, and we did as well, and the results are very similar. So, for instance, this is just looking at a group of exchanges, and during that same time frame of March, and you can see the order book spreads, how it behaved very similar to what you're seeing on the inflows and outflows. Obviously, when there is a lot of money going out of the exchange, there is less liquidity. The spreads tend to widen a little bit. So what you should not see is obviously a lot of money coming into the exchange, right? And then the spreads going crazy, right? So you should, correlating those two give you a very good idea of whether an exchange is really manipulating the order book, because you're looking at some correlation with the on-chain activity. And in the bad exchanges, you're gonna find that. You're gonna see that you're seeing trades and orders in the order book that have no correlation with the flows that you're seeing in and out of the exchanges at the blockchain level. And that's what we think, that this type of methodology, this type of metrics is highly complementary by just looking at the order book. Now, one thing that I mentioned about the fact of just analyzing order books is that order books are great of detecting anomalies and maybe things that deviate from the norm, but they're a really bad mechanism to analyze liquidity. However, if you're looking at the composition of an exchange with a high degree of accuracy, the deposits that are being held in the deposit addresses, the cold wallets and the hot wallets, they should approximate the reserve of the exchange. So that's what we call the inventory. It's not exact, but it should be a good approximation, right? Everything that the exchange holds. And by the same similar analysis to the one we provided before, looking at the inventory correlated with the exchange order books, it will give you an idea of liquidity. So if you see the inventory going down like crazy, but then the spreads, they don't widen even a little bit. So you can see here, the inventory of this exchange was decreasing, but the spreads were, because there is less liquidity, the spreads tend to be wider. right? If you don't see those patterns, that's a sign of market manipulation. And this is something that you can only do by looking at the blockchain footprint, blockchain footprint of a lot of these metrics and correlated with the order books. Now, idea number 4 that is maybe a little bit more less conventional is if you look at a big exchange like Coinbase, like Binance, like Kraken, they regularly need to interact with liquidity providers, with market makers in the blockchains, in the crypto space. So if we can follow a similar methodology and identify the key wallets of those market makers, you should see regular transfers from those market makers to wallets. If you see an exchange that doesn't have that, that is faking liquidity in the order books, but there is no interaction with market makers or with liquidity providers on chain, I mean, that's a huge red flag. And those footprints are all over when you look at some of these exchanges. So this is this pattern at a blockchain level. So this is the hot wallet of a liquidity provider regularly doing multiple transactions to this is a hot wallet of a very prominent crypto exchange. And you should see that pattern very, very regular. Because if not, an exchange at a scale cannot operate by just the liquidity provided by traders and other entities. You need liquidity providers that transfer big amounts in order to operate. Now, the 5th idea that is also not very well explored in the mainstream is if we have the composition of an exchange on chain, you should think about that as a subset of the blockchain, right? The Binance footprint on chain is a subset of for Bitcoin is a subset of the Bitcoin blockchain. So many of the techniques that we apply to analyze addresses and transactions and things like that to entire blockchains, they can be applicable to a subset of the addresses, right, that belong to a specific exchange. One area that we're super interested on is, because we do a lot of analysis on this, is liquidity and profitability. So one of the analytics that is very popular in IntoTheBlock is this one that we call, it's a series of analytics today that try to give you an idea of profitability for an asset called the in and out of the money, in which, to summarize it very quickly, uses a convoluted machine learning technique to provide an idea of who's making money, losing money with a given asset. The clusters in red are losing money compared to the current price. The clusters in green are in the money. Now, in that same analysis for withdrawal addresses in an exchange should show a uniform correlation over time. So if you're looking at the withdrawal addresses for a specific exchange and you see every address out of the money, completely, that's crazy, right? Like there is something wrong with that. So if you see every address in the money, there is something wrong with that. So that distribution should be consistent over time and should be consistent with the market, right? Like if you're seeing some patterns on Binance, there is no reason to believe that a mid-tier exchange should deviate too much from that in the aggregate, right? In the distribution of those addresses. Like this market is not that big to have that many differences. So these are just some 5 ideas that I wanted to run by you, that I know they're a little bit up there, but they try to bring the perspective of incorporating blockchain analytics into the subject of liquidity and fake volumes. Very soon in the IntoTheBlock platform, you're gonna have these measures of liquidity based on blockchain analysis, completely driven by machine learning. We're not creating accounts in exchanges and things like that. It's completely and models that have learned the composition of the blockchain, and this is days away from shipping. But to summarize what we have just discussed, so exchange liquidity and fake volumes are a huge issue in this market. It's a huge issue for traders, for regulators, for dApps, for exchanges, for everyone. So addressing this problem is not about creating a sophisticated score. That might or might not work. I think it's not going to work, but it's certainly, it shouldn't be the end goal. It could be a side effect. The way to address this is to tackle those specific challenges one by one. In my opinion, 90% of them are machine learning problems, that there is no way that you can tackle this by just looking at time series in an order book. But I could be wrong about that. But what I'm probably right is that it requires very atomic solutions combined to get an idea, a better idea of bad actors, fake volume, bad behavior, liquidity, and things like that. The blockchain datasets provide a very new dimension to this problem. And using machine learning classification methods, you can actually get very far on trying to classify a specific subsets of the blockchain as addresses and transactions that belong to a specific exchange. And once you have that, the analysis because that's very hard to fake and that's very difficult and expensive to fake. So the data that is there is mostly legit. And so having that data set de-anonymized, it gives you a new set of possibilities, as we have shown with those 5 ideas, to explore real liquidity, to quantify real liquidity and percent spikes of fake volume on different exchanges. So I'm going to, there are a few questions in the poll, so I'm gonna start answering those. But before that, I would like to introduce our next webinar that is gonna be about one of the hottest topics in the industry these days, that is decentralized finance. Everybody's talking about DeFi. What we're gonna do is we're gonna give you 30 minutes. We're just gonna be looking at all sorts of crazy analytics about DeFi metrics, indicators, signals, and things that are not exploring the market that we should know about, that are looking at all these new protocols and try to provide some insights about the space. What's reality, what's fiction, what's overhype, and try to look at it from the data perspective. That's gonna be on August 8th. So you can, if you look at the chat right now, there is the link to subscribe. So please go and subscribe. And I'm gonna take a couple of minutes to answer a few questions. So Adam is asking, obviously, wash trading is illegal on regulated markets. Are there any arguments in favor of it? And so that's question number 1. So if you look at the Bitwise report, they sort of, the changes that they say that they're the good ones are the regulated ones for the most part, 90% of it. So but if you put the rule of law as a dimension to this problem, then obviously exchanges are going to have less incentive to behave to create wash trades and things like that. Now the question that you're asking is if I see any arguments in favor of wash trading. I don't subscribe to this. Well, I actually have doubts with this. So in crypto, I don't, because the market is too small. Now, in a large market, like US equities and things like that, there are people that will make the argument that the market is so efficient that you can enable wash trade, that is hard to fight with regulation. So you can enable wash trading, insider trading, made all those things legal, and the market will correct itself. So that's a theory that has been around for a very, very long time. I think in a small market, it's suicidal to try to do that, because it's completely asymmetrical, right? The amount of infrastructure that an exchange like Binance or OKEx and all that have, and information is completely asymmetrical from the normal guys. So, but in a large market, you can make the case. I don't subscribe to that thesis, but there are many people that do, that all those mechanisms will autocorrect themselves in the long term. Then the second question is, do you have metrics on varying length of time to complete transaction, different exchanges, different crypto? Yeah, absolutely. So we have, as I said, a number of machine learning classifiers that have been trained on different Bitcoin, Ethereum, Litecoin, Bitcoin Cash, or blockchains, and are able to classify exchanges and addresses and transactions with very high degrees of accuracy. Some of that you're going to see in the product, very soon. Some of that we use it internally for the signals that you see in the product. They discriminate some of those addresses. Some of that we're using it as part of the predictive strategies that that we're working on, and we're not shipping those to publicly just yet. And then there is so Adam follows up with another question saying, we would like to know who are the untrustworthy actors. Do we provide? We don't do. We focus on finance information. Try to tackle this problem from the finance perspective. We don't. We're not working on the using this for anti-money IntoTheBlock for anti-money laundering or regulations or things like that. That's one part of the problem. The second part is that you can identify bad behavior is one thing, de-anonymizing that is another, right? So you can identify these addresses are causing this bad behavior, but then getting to who is behind that is really hard. Fernando said he loved the webinars. Thank you very much, Fernando, for making the time to join. Let me, and if you guys look at the chat, there is the link to the next webinar. It's about DeFi. Everybody's very excited about that, and we're one of the first company tackling deep learning analytics in this space. So if there are no more questions, I would like to thank you very much for joining today. I hope you stay safe. I hope you enjoy the content, and I hope to see you in the next edition of this series. Thank you very much.